Great. Thank you so much for this opportunity, and thank you everyone for being with us today. Uh, so what I want to do is let me just pull up and share the screen. Right. So today I'll be sharing a bit of detail regarding two strategies that we have, both being Sharia, uh, China and India. Now, one of the things I aim to do is hopefully to answer and provide color to as many questions that we've gotten and we've received over the period regarding China and also India. Now, when we think about Sharia, in order to ensure or in order to provide peace of mind to our investors, we ensure that the portfolios are Sharia compliant by undergoing two levels of screening. The first is going to be business activity. This basically means we don't invest in sin stocks, pork-related products, your conventional financial services, or armaments. And the second is financial screening. And this is to make sure that we're investing in companies whose financial health is not in question. And we've seen over the past 2 years that this is going to be an extremely important element to how we allocate our capital into specific names. Now, these two levels of screening are applied to both the Sharia China and also the India portfolios. And for the two strategies, what I'll do is cover the macroeconomic backdrop and then discuss in a little bit more detail how our outlook is reflected in these two strategies. So first, I'll start with the Sharia China equity strategy. Now, before I even talk about some of the policies within China, I think in 2021, this was effectively a resetting of expectations. This was a year for a resetting of expectations. We had policy and regulatory risk or uncertainty at the beginning of the year. And in the second half, we had concerns regarding the liquidity of certain property developers. Now, property is obviously a very large part, or very large contributor to the Chinese economy, roughly about 20%. And, at a very high level, we don't believe that China is going to allow this sector to have a hard landing impact on the economy. Recently, we've seen more policies in place that has allowed the easing of some of these liquidity concerns within the real estate sector. And that kind of points me to this slide here. One of the things currently that China has in its back pocket is that it's actually diverging from some of the more developed markets. So you see a lot of different economies and governments tightening, whereas in China, they have the opportunity to loosen, to help support growth. This year, in 2022, China is estimated to grow between 4 and 5%. This is definitely lower than what we saw in 2021, but yet 5% is still what we believe relatively healthy. Again, 2021 was a year of resetting of expectations, and 2022 hopefully can capitalize on some of these new expectations. But as you can see here, inflation is not a concern within China, which allows the Chinese government to put into place more supportive policies from fiscal and also monetary. Now, given that we do see the impact of policy headwind, we also have to understand that there are structural growth themes, trends, and also policy companies and sectors that would benefit from policy support. For the portfolios and for the investment team, there are three primary thematics that we're positioning the portfolio. The first is going to be within consumption upgrade. Obviously, consumption upgrade means different things at different times, but currently what we're seeing is a large scale upgrade within China. This is going to be part and parcel to the middle class reaching critical mass. We're seeing a greater part of the economy driven domestically, and also focused more on domestic brands. And this is going to range from, your everyday consumer discretionary or your everyday consumer staples into clothing brands, EV, and also which moves into the tech and innovation, your homegrown and your localization of supply chains, right? So this is going to be the first part. The second thematic is technology and innovation. Now, obviously, 5G ecosystem is very broad and very deep. And for us, what we're looking at really is going to be along the supply chain. We believe that opportunities exist along the supply chain because there are a lot of moving parts for this ecosystem. And there are a number of names, particularly in the domestic Asia market, that fit into this thematic. The other part within tech and innovation is going to be biotech. We are looking for companies that have the ability to develop innovative drugs that are going to be a bit insulated from policy that generally impact generic drugs. So what we're really looking for are those that can innovate and those that can ultimately reinvest in their businesses. And finally, last but not least, within the tech and innovation sector is really sustainability. This is going to be a big topic. And a lot of this sustainability that is driving innovation falls along renewable energy supply chain. And this extends all the way to electric vehicle supply chain. But this is really a part of the Chinese government led efforts to be carbon neutral by 2050. Now, that also flows into the next thematic, which is supportive policy. Although we've had some policy headwinds, we also have to remember that there are policy tailwinds. And this is going to be in areas such as environmental protection, supply side reforms, which is talking about localization of supply chains. And finally, looking at industrial policy shifts, really thinking about moving from your traditional manufacturing into smart manufacturing. So these are really the three key themes on how we're trying to express our view in China within the portfolio. So the first, as you can see here, is really talking about clean and renewable energy. Again, carbon neutrality, we spoke earlier, by 2060, provides China a number, like quite a long runway, and provides these companies quite a long runway to help achieve, or to help the Chinese economy achieve these goals. What we see here is that when we look at the primary source of energy consumption in China on the right-hand side, coal is becoming a smaller and smaller amount. Renewable is becoming a bigger and bigger chunk. So when we think about where renewable energy is coming from, we're not looking to invest necessarily in solar farms or wind farms, but we're looking to invest along the supply chain, meaning technology parts that go into wind turbines. Basically, companies that develop high voltage cables in order to transmit the energy that's produced by wind farm and solar. So this ecosystem of renewable energy is quite broad, it is quite big, and it presents quite a number of different investment opportunities for us to take advantage of this policy tailwind for clean and renewable energy. And the second slide here really is sticking with that renewable energy theme. However, we're talking about electric vehicles. Now, when we think about electric vehicles, the key source here is not really the end product. It is not the electric vehicle itself, but it really is focused on the components that go into electric vehicles. And as you can see on the chart on the right-hand side, China is already, by market share, the largest manufacturer of electric vehicle batteries, not only for domestic use, but also for international use. Now, one of the things that has created greater opportunities when we think about EV batteries is not only EV battery demand itself, but that this battery is going to result in greater investment, greater development within energy storage. So once this energy is stored, it is not permanent. There is going to be some degradation in energy that's being stored. Now, the better technology you have, the less leakage you'll have from this, from basically having it sit. Now, with this creates opportunities along the supply chain. And I think for us, supply chain is going to be extremely important when we talk about renewable energy. So we have renewable energy in the form of components that go into producing wind, solar power, that go into transmitting this power into industrial or personal use. And then we also have electric vehicles, not only adoption of the electric vehicle itself, but also from battery manufacturer and the supply chain that it provides opportunities in. And the reason why we are positive, or this positive on renewable energy, is because historically, when we think about sources of energy and the costs to produce these sources of energy, things like wind and solar were always more expensive than looking at coal. Again, coal was one of the cheapest sources of energy because coal was plentiful. However, given the supply side reforms to reduce the number of coal mines in order to reduce the pollutive impact of coal, government policy has been put in place to actually make solar, to make wind power much more affordable. So when we talk about grid parity, what that means is the cost to produce energy relative to the cost to produce energy using coal. And as we can see here, by next year, wind is going to be close to coal, but solar is actually going to be cheaper to produce than your traditional coal-fired power. So this is something that is not only going to take place within the next year, but we feel, again, that this has an extremely long runway. The second theme is going to be innovation. So when we think about biotech, we're not only just thinking about those that can produce innovative drugs. We're also, again, looking along the supply chain. Now, this chart here talks about basically CROs, and CROs are effectively contract research organizations. What they do is that they effectively allow biotech companies to do what they do best, right? Which effectively is discovering the drug and then at the end, market the drug. These CROs fill an important need in the sense that although they participate in the discovery, their value add really is going to be in the preclinical and the clinical trials. And as we know, the preclinical and clinical trials do actually take time. And if your biotech companies are doing this themselves, they're spending less time on the drug discovery front and on the marketing front. So these companies are not only having and securing contracts within China, but they're also doing it for drug companies in the US. So this growth potential is not just focused on the end product of the drug, but it is focused on the process of development. And we feel that this opportunity is differentiated, but at the same time, there is a large opportunity set for these companies. And within innovation, we are still going to talk about quite a bit this thematic of self-sufficiency for technology for China. Since 2016 and 17, when we did have US-China trade tensions, when we did have quite a bit of talks about technology use and the restriction of companies being able to sell into China, I think China really had to think about their path when it comes to technology, when it comes to self-sufficiency, and when it comes to really being able to secure supply. Now, currently, when we think about the self-sufficiency, this table here talks about microcontroller units. Now, these are relatively low tech, but extremely important. So microcontroller units are basic semiconductors that go into things like home appliances, but at the same time, they are also go into electric vehicles, go into smartphones, but these are more low tech. As you can see, China has increased their self-sufficiency, so they don't have to rely on foreign countries in order to secure supply. Now, once China has established self-sufficiency in some of these low tech, the next step obviously is to move into high tech. However, your within technology, a global supply chain is going to be extremely important. So it's not to say that China is going to close itself off from the rest of the world, but they are now focused on relying more domestically as opposed to externally. And this consumption upgrade theme, one of the things that we've noticed over the past decade is that consumers now are focused more on domestic brands. So the Nikes, the Adidases of the world, that upgrade took place maybe 7, 8, 9, 10 years ago. But today, as you have a larger middle class, a larger millennial base to spend, what they're looking for really is going to be domestic brands. When you look on the left-hand side, what we're seeing is that percentage of online searches for the domestic brands over the past 10 years has really shifted towards your Chinese brands. And this is not only for clothing, but this is also moved to cosmetics. In China historically, and I think globally even, Korean cosmetics has really had a strong foothold. However, domestically, what we're seeing now, particularly with the younger consumers, is that their shift and their preference now is moving towards China's brands. This is something that is going, we believe, to continue for the longer term. So before I move into the Indian equity strategy, I think a few points just to sum up what we think about China. Number one, we think that peak policy risk when it comes to kind of the regulatory environment and also for property is behind us. 2021 again was a resetting of expectation because of these two dynamics. Going forward, our focus is going to be on three things: consumption upgrade, tech and innovation, and policy supportive or companies that are going to benefit from government policy. Although there are policy headwinds, we have to remember that there are companies that are going to benefit from these policy tailwinds. And finally, as we're looking to structure the portfolio, our approach really is going to be bottom up. We are looking for these companies that can grow regardless of the environment that regardless of the economic environment that we're in. Although China's growth is expected to slow, I think this expectation has already been in place. And now being able to identify these winners, we believe is going to provide the most attractive risk-adjusted return for our investors. So then I'll go into the Shariah India equity strategy before going into Q&A. Now, for those who have followed Manulife's Indian equity conventional product, you understand, you know, and you're familiar with some of these slides that I'm going to present. However, what I want to do is kind of set the scene, provide a backdrop for what happened previously and where we are today. So now in 2014 in India, the current Prime Minister Modi was elected. And from that point on, he has put into place reforms that have led and allowed some of these structural imbalances to be addressed. So one of the big things about India back in 2014 is that it was largely a cash-based economy. Cash-based leads to lower productivity, leads to greater tax leakages. And this sets off a chain of events that, even though expectations for growth in India were high, they were not realized historically. So one of the key things that the government did was really transform this cash-based economy into a formal economy. And once you have this formalization, what we see really is greater productivity, greater productivity, greater investment opportunities. And because a lot of these transactions, a lot of the economy now is going to have to pay tax, so tax leakages are being addressed. This allows the government to put into place policies that should benefit growth going forward. Now, initially, before Modi was, or when Modi was first elected, the banking system was straddled with a lot of bad debt. The reforms that were put into place really looked to address that. So when we had reforms and when we had this formalization efforts, this led to greater fiscal stability and financialization, meaning consumers like you and I are able to be a part of this banking system. So you have to remember, when India was cash-based, there was no need for us to be a part of this economy, part of this formal economy, excuse me. But now, with financialization, we're a part of this formal economy. We have access to bank, we have access to financing, and all of this is going to lead to greater growth opportunities that the Indian government can start to invest in. Now, once these 4 Fs on the left-hand side has been established and in place, from 2019, how is it that the Indian government can capitalize on these reforms? Now, we call them the 3 Rs, which is recycle, rebuild, and reinvest. The recycling really is having the government free up resources through selling and relaxing SOE ownership. So you've seen a lot of these state-owned enterprises being sold to private investors. All of this really is basically allowing the government to strengthen its bank account. And when the bank account is strengthened, they're able to spend more on things like infrastructure projects, spend more things like rural development without having to incur a higher cost of debt or actually impacting your fiscal accounts. Once they're able to do that, once they're able to build the strength of their balance sheet, they're able to boost savings, not only at the corporate level, but also at the personal level. And when we say boost savings, what they've done is they've lowered tax rates. So now India has one of the lowest tax rates for new manufacturing facilities built domestically. This has really allowed a revival of CapEx, but it has also allowed companies to be incentivized to reinvest their earnings into basically projects domestically at higher ROEs. Again, because this is a benefit of lower tax, which is a direct benefit of being able to strengthen the government's fiscal account. So once we have the foundation of formalization in place, and then we had the path of how the government is going to take advantage of this formalization, it has resulted in really 2 overlapping cycles of growth. So on the left, your formalization of the economy takes place because, again, because of the digitization, meaning businesses that were not cash-based were able to participate in a thriving e-commerce ecosystem that has developed over the past 7-8 years within India. And as we've seen through COVID, e-commerce is one of the largest sources of retail participation. And if companies aren't able to participate in this e-commerce, they're not going to survive. They either need to be acquired or they're going to cease operating. What digitization forces companies to formalize, which then in turn forces those who are not formalized to be in the digital economy. This is that first cycle. The second is going to be on the right-hand side, which is India really needs to have a larger part of its GDP come from manufacturing. In order to do that, the country needed to incentivize MNCs and domestic companies to manufacture more in India. How do they do that? Well, they're able to do that through lower tax rate, through production-linked incentives, and also because India has a large and young population base that is educated, that can help grow some of these new industrial and more tech-oriented type of sectors. And this is going to lead to greater import and export substitution opportunities. So as you can
Mr.
see on the,
Derrick,
yes,
Mr. Derrick, so sorry to interrupt. You have 7 more minutes left.
no problem.
Yeah, all right.
Okay, I'll go through these quickly so that we can actually go into Q&A. So when we think about e-commerce and how big the opportunity set is, as you can see on the on the top right-hand corner, digital payments for as a percentage of GDP continue to move higher. However, right below that, e-commerce as a percentage of overall retail sales is still one of the lowest in the region and even globally. So this is one way that we believe the formalization will drive digitization growth and then create that first cycle of growth. Now, in this slide, we talk about manufacturing. As you can see on the upper right, you have a rising share of exports expected in 2022, and we believe that this is going to continue. India has already has a very strong presence in manufacturing. So domestic electronics is going to be on the low end, but as you have these production-linked incentives being put in, what we're going to see is that more and more companies are going to invest into manufacturing things like telecom infrastructure, white goods, automobiles, pharma, and then later on move into really the emerging areas. So solar cells and advanced like basically chemicals. And we expect this to actually take place over the next 5 to 7 years, which is really going to add quite a bit of value when it comes to India's drive towards greater manufacturing growth. Now, what does all this mean? All this basically means you have a stronger fiscal and you have a stronger current account. This is going to allow the Reserve Bank of India to have more options when it comes to setting monetary policy because you have inflation that is under control. And finally, valuation has always been a question that we have received. India really is, historically traded, is trading currently a bit higher than it has historically. However, when we think about valuations, we need to take it in the context of growth. On the upper left-hand chart, you can see that, we're not taking it from the low base of 2020. We're looking at 2019. Over the next 5 years, you're going to see a compounded annual earnings growth rate of 17%. This is going to be driven by the reforms that were put in place. In 2022 and even in 2023, India is expected to be one of the largest or one of the fastest growers in terms of GDP. And although valuations are a bit high today, there are going to be sectors in which there are opportunities, particularly within kind of the smaller cap companies. Right? So given time, I would stop here for a formal presentation and would be happy to answer any questions.
Yeah, thank you so much, Mr. Derrick. So sorry that due to the time constraint, you cannot move on with your presentation. So moving on, I will pick 2 questions to ask. Okay, so one will be, so since now the Manulife India Fund has been doing better than the China Fund, so will the China funds overtake India Fund in the future as China seems to be doing better? Or which one between India and China, which offer better growth prospect in the future?
Right, so that's a great question. I think India and China are really 2 different territories, but currently they complement each other, right? In China, you do see slower growth than previous. You do have this regulatory overhang, and they are growing due to dual circulation, meaning they want to grow domestically, and then in turn look at how they can export this domestic growth. India, however, you're looking at different drivers of domestic growth. You don't have regulatory uncertainty, but both of these are going to be key, basically economies globally. Obviously, China has had its issues over the second half of the year, as we know. And what we believe is that peak policy risk is behind us. Over the past week, we've seen the Chinese government loosen policy measures, particularly within real estate, and markets have actually rallied behind that. So the question of, will the fund overtake India or will the China fund overtake India? I think when we look over a long-term perspective, these are 2 economies and 2 funds that we believe are going to do well.
All right, thank you so much for your insights. And then for the second questions, Just now you were presenting on biotech. However, recent biotech ranked among the worst sectors performance. So why? How do you think so about this sector?
Right. So great question. In China, biotech really took a hit over the last quarter. And the reason for that is more technical as opposed to fundamental. The reason why I say that is there's one large company that's listed in Hong Kong and has ADRs. And the previous speaker also mentioned, the risk of delistings in the US. But at the same time, there's also this blacklist, a restricted list for US investors to invest in companies. And the US government wanted to put some of these biotech companies on that blacklist. However, when we actually do really our work, we understand that it's either has to be military, it has to be data, or it has to threaten national security, right? For biotech, it's very hard to find kind of a company that satisfies these three requirements in order to be blacklisted in the US, right? So our focus is less on these technical measures and is going to be more so on kind of the fundamental aspects. Now, obviously for biotech and for healthcare in general, you're going to see potentially some regulatory risk because of things like group purchasing. So in order to be on China's national reimbursement list from a drug perspective, you have to actually lower the price of your drugs. But this really is focused more on generics than on innovative drugs. And our focus really is going to be on innovative drugs.
All right. Thank you so much, Mr. Derrick, for your insightful answers. And due to the time constraints, so we will need to stop here right now. So we do have a lot of questions coming in still, but no worries. Okay. Maybe we could invite you again for our webinar ahead this year so that our investors can join again. All right. Thank you so much for your sharing.
Thank you so much. Great. Have a great weekend, everybody. Thank you.
Yeah, you too.